Okay, folks, welcome to Thursday Night Stock Charts Live. Another Thursday. Thank you, Lord, for another week, another live stream. And what we're going to talk about tonight is Dow 40,000. Amazing. We touched it, couldn't hold it. We'll talk about that. But does it really matter? Not really. What matters is where to from here. So, as we normally do on Thursday nights, we're going to talk about the weekly charts, how we're poised to close out the week, maybe, because we know a lot can happen on a Friday, changing the map the way it looks on Thursday night. By the end of business on Friday, those charts could look a lot different than they did on Thursday night. So we're going to talk about those charts. And more importantly, I would argue is that can we hold our current gains, both short-term and longer term? We're going to talk about that. Is this bull market, does it have legs? Does it have legs? And we'll spend a good amount of time this evening talking about those legs, price targets for the Dow Jones, since we had Dow 40,000. That's going to be the topic of conversation by and large. However, it's not going to be isolated to that. It's also going to be a conversation about commodities. What are we seeing in the commodities market that is ultimately going to drive us towards a yield curve steepening, therefore a bearish event in the equity market? And we'll talk about where we stand with that yield curve. How do we look so far in the month of May in terms of a yield curve steepening? I mean, we closed out last month with a very, very bullish month on the yield curve, extraordinarily bullish. And we're going to talk about where we are this month so far, halfway through the month. How are we looking? Because we know if that yield curve steepens and uninverts, historically, that is very, very bearish for the equity market. So the futures markets are open. We have, really quick, the NASDAQ 100 top chart up aggressively, but it's off of its session lows, I should say. It's still down in relative to the close, but wrong mouse. But they're really struggling to get this to turn positive. Now, we did not have a good close today in the equities markets at all. And you can see here that volatility, which we're going to go over a weekly chart in a moment, has broken out. Okay. This is only a 1 minute chart, so let's not spend all too much time on this. Now, what I think is more important, in addition to volatility rising, is the 10-year yield. The 10-year yield rallied today. And we spoke about this last night on Market Wrap, that I was concerned about the, and by the way, don't try to join up. We still have a problem with our membership software, so don't try to join up, please. I'll let you know when you're able to. We expected that we were going to get a counter trend rally in the 10-year yield and the VIX. We got it today. So do they have legs? We'll talk about that. So we have a lot to cover. We're not going to talk. It's not Sunday. Normally I go over a lot of charts on the futures on Sunday nights, but it being Thursday, let's stick with our regular script and let's get started. So let's take a moment and go over the this is what happens when you don't prepare appropriately prior to going live. You get embarrassed. Okay, so let's talk about the economic data that has been released this week. The producer price index, which came out on Tuesday, came in hot, hella hot, hella hot. At the core, again, hella hot. What did the markets do? They sold off hard, very, very hard. But then Wednesday came. And actually, no, I'm sorry. Tuesday, they tried to sell it off. They rallied them. Wednesday, same deal, followed through rally because at the headline number, we came in less worse than what was expected. And at the core, about what was expected. Year over year came in as expected, 3.4%. Now, the thing to remember about this number is that they continue to take off items out of the CPI metrics that could influence this higher. What am I talking about? We spoke about this on Sunday night. They adjusted how they calculate the CPI. They took out coffee. Has anyone seen coffee prices? Coffee prices since 2019 have been on a tear. Even for this year, they've been on a tear. Up on the year, they're off the highs. Up on the year, nearly 6%. All right, so clearly outpacing the rate of CPI, that 3.4% number. So when you have a government that continues to manipulate the data, that doesn't address the problem. The problem is still existing. It's just not being reported. But the equity markets don't care about that. They want to be lied to. They really do. The equity markets, Wall Street is very, very odd. They want to be lied to. So the fact that the coffee prices were dropped out of the CPI number matters little to none whatsoever. What matters is the headline, and the algorithms took it and ran. So we had some economic data that was released today, and I'll go to the articles. Jobless claims decline after last week's big surge amid New York chaos. So it's a good thing jobless claims decline. The problem is that when you take a look at continuing jobless claims, people that have been laid off, they're not getting new jobs. They're not getting rehired, or they're not looking for work. One of the two, or a mixture of both. I'm sure it's a mixture of both. And also, when you take a look at this number, here in green are initial jobless claims. And in red are challenger U.S. job cuts announcements as of April 30th. So these are companies pre-warning the market, saying, listen, we're gonna be laying off people soon. We're gonna be laying off. Yet, despite the fact that that number has jumped up from what these used to all be in sync up and until, let's call it, March of 2021. That all changed. Initial jobless claims have stayed flat, whereas I don't know what this U.S. worker adjustment is, so I'm not going to talk about that. Challenger U.S. job cut announcements I'm familiar with. Despite the fact that we've had all of these layoff announcements, not a bump up in initial jobless claims. I don't believe in irony in the markets or in the economy or in politics. I believe that something stinks in Denmark. Something's rotten in Denmark, whatever that saying is. So that's initial jobless claims. Also today, industrial production disappoints, manufacturing contracts as downward revisions continue. Why does this matter? So we're seeing industrial production disappoint, poor economic data, yet prices are going up 3.4%. Remember, the Fed wants 2%. We're way beyond 2%. I mean, that's in the rearview mirror. And if you believe that number, 3.4%, then I have a bridge to sell you in Brooklyn. So that's stagflation. That's a stagflationary environment. That's a perfect petri dish for commodities. You want to own commodities. And I've made it a point these past couple of weeks to be trading futures on commodities, whether it be soybeans, natural gas, oil, what have you. I've traded a number of them. Pretty good. It's been a pretty good run. But I'm no pro at futures. I don't know the nuances and intricacies as of yet, but I'll tell you, it's really, really interesting stuff. Cheap, not subject to pattern day trading rules if you have a small account. What else? And the fees are fairly reasonable. So, and a very liquid market most of the times. Oh, and wheat I've traded. Wheat. What else? This is, come on, give me a break. This is not what I wanted to go to first. Okay. U.S. housing starts, permits ugly in April. Why does this matter? It matters because housing, those construction jobs are huge, have a huge impact on the overall economy. Contractors need to buy equipment. The workers that go to work every day, they need to buy lunch. They help the neighborhood delicatessen. It's just a ripple effect, a huge effect on the economy. You need transportation. You need all sorts of things when you have construction going on. So that's one leg. The second leg are building permits. What does this mean? Why does this matter? Building permits are a forward-looking indicator for construction, contractors breaking ground. If you see a decline in building permits, well, that's a problem. That's telling you that looking forward, housing starts are going to be somewhat benign. You're not going to have the growth that you had. Major problem. I did not stop and say hello to people. How rude. I apologize. Small crowd tonight. What is there, a game on? Sean, welcome, brother. Jeff, welcome. TZ Burton, welcome, buddy. And Trader Isaac, welcome all. Okay. I found this interesting, so I thought I would share. In less than 4 years, inflation-adjusted U.S. spending, government spending, now exceeds the combined spending of World War I, World War II, and 1970 to 1990. This is extremely worrying for the long-term health of the economy. But everyone except for the U.S. government seems to understand that. So here's the chart. It's kind of scary. It's really kind of scary. And the problem is that when we do enter the next recession, and we're overdue. The yield curve's been inverted for the longest period of time ever. So once we begin to uninvert and we go into recession, the government's not going to cut back on spending. That's the last thing they're going to want to do. They're going to need to spend like drunken sailors, even worse than what they're doing right now. So, and the Federal Reserve, they're going to get that money printer going. Brrr. So this is only going to get worse. I don't care if it's Biden in office. I don't care if it's Trump in office. It's going to be the same thing. Anybody who cuts back on government spending is going to wreak the wrath of both the bond market and the stock market. The stock market in particular. Why is that? Because the only reason is that we have a GDP growth that is as high as what it is right now is because of government spending. What happens when they cut that back? Well, look at GDP. It goes to hell in a handbasket. So expect more government spending. And if President Trump does get into office, he is a low rates real estate guy. The last thing he's going to want are higher yields. So if there's going to be a need for a massive amount of job cuts at the federal level. Hopefully he has the stomach to do that. But absent that, we have major problems. I don't care who sits in that office. It's going to take some real drastic government spending cuts and government headcount cuts. As much as I don't want to see another person lose their job, Unfortunately, the government's way too big and highly inefficient. Let's talk a little bit about the CME, Fed Watch tool. Now, for September, by and large, this was above 70% this morning. Then we got and there's jobless claims that came out, and this dropped back down to 67%, where it's really been on average for the past week. So it looks as though at current this snapshot in time, the Federal Reserve is going to cut rates. They're going to cut rates into a GDP of, supposedly, according to the Atlanta Federal Reserve, they're projecting a 4% GDP growth. The historical average is 2%. They're projecting a 4% GDP growth. Inflation is still on the rise, nowhere near 2%. Yet, the market is projecting a September cut. I don't know how that works. Never in history has that happened. So it's going to be very interesting to see how this autumn shakes out. We have an election coming up, and we have September that's got a target on its back as being the first rate cut of 2024. We'll see if it happens. Fed Watch tool. Now, the last Fed meeting, during the presser, Jay Powell said that he was going to begin a reduction of, I think the number was roughly $37 billion per month, less in roll-off off of the Federal Reserve's balance sheet. So I always say, don't listen to what they say, watch what they do. Don't listen to what they say, watch what they do. So has there been any indication since that Fed meeting that the reduction, the rate of change on the Fed's balance sheet is declining? No. No. We really, like last week was pretty much unchanged, but week over week, man, they dropped it by about $50 billion off of the Fed's balance sheet. But here's a 5-year view. We're still very, very elevated. I think the Federal Reserve is attempting to do their best to keep the markets in check while trying to unload as much of this paper onto the markets before they need to load back up again and bail out this economy one more time. That's what I believe. I think that's why it's still showing that they're going to go for a rate cut in September. Always remember that the first rate cut is usually a top in the stock market. So if people are betting that the markets are going to rally in September due to the first rate cut, they better think again. Enjoy the rally while it lasts, because this is going to be a major problem if, in fact, they do cut rates in September. Historically, no bueno for the equity market. Now, can this market rally continue? You know, if you take a look at the Shiller PE ratio, you take a look at this and you say, Jesus, Mary and Joseph, we're approaching 2021 levels, and it's scary. I mean, on PE, price to earnings multiple, trailing basis. This is on a trailing basis, so pretty expensive. And then when you take a look at it on a forward basis, now remember, we're pretty much done with earnings. We have Adobe, we have NVIDIA, we have FedEx coming up, a few laggards at the end of earnings season. The forward 12-month PE ratio for the S&P 500 is 20.4. It's above the 5-year average of 19.1 and above the 10-year average of 17.8. So both on a rearview mirror basis and on a forward-looking basis, the equity markets are expensive. However, if you lived like me and traded like me during the 2000 top, you know that equities could get far more expensive than where we're at right now. So can the equity markets proceed up higher? Yes, they can. Now, the Dow Jones, what was that noise? What was that noise? Weird. Okay. The Dow Jones Industrial Average. This is a weekly chart. I don't want the weekly chart. Daily chart. I'm going to try this again. Daily chart. Touched 40,000 today. Touched that big round number and did a bearish reversal bar. We have our stochastics very, very overbought. They can remain overbought. RSI at 68.68, nearing overbought levels, certainly not quote unquote overbought as of yet. Now, when you take a look at this breakout, I have a couple of problems with it. And let's get our crayon out here and let's talk about it, because I'm always talking about retests. As a technician, most technicians like me, we're OCD, obsessive compulsive disorder. We need to see validation. We need to see a breakout and then a retest. What was resistance must now be retested for support. It's just built into the DNA of a technician. So when you take a look at these names, Dow Jones broke out, never look back, never look back. Even if you go here, no retest. We consolidated, ripped up higher. And this is a week where we had hot inflation data. Yet the markets are still pricing in a rate cut for September. I think it's a little bit delusional, but we've been here before. The markets could stay far more delusional than we can stay solvent if we try to short the market. So as I mentioned to members earlier, you know, if you're looking to short this market, I think it's an okay time, not a great time, but an okay time. If you want to put a short bet on, sell a deep out of the money call spread, be done with it, get it out of the way. I would not be highly directional, meaning shorting the market outright right now. I wouldn't do it. Even though we have not yet pulled back and done these retests, I wouldn't do it yet. It's not time. So you'll know when it's time. You'll know when it's time. So going to the weekly view and saying, okay, can this market press up higher? You're killing me. Let's clean this up. I had everything set up nicely. Let's get rid of all of these lines. I had this nice and clean before. Okay. So here's the weekly chart, Dow Jones Industrial Average. We broke out of this ascending wedge formation. Usually this gets resolved down. It didn't this time. It got resolved up. No retest though, even on a weekly time frame. It just went parabolic. I think we're heading to 41,000 on the Dow Jones. That being said, I think that we need to have a retest of at least one of these breakout points on the charts. So we'll talk about the Qs in a moment. I think that's even a more egregious in technician world, of the more egregious felon, the more nefarious chart for not doing a retest. So that's my take on the Dow Jones. Can it move up higher? Absolutely, yes. But I think we get a retest short term. So speaking of valuations of the equity markets, and I'm trying to mix this up, negative, positive, negative, positive. So the U.S. equity market cap to GDP ratio, this is the Buffett indicator, is near an all-time high at approximately 187%, suggesting a significant overvaluation of the U.S. stock market. And remember, the GDP is built upon government spending, not organic growth. So you have, in essence, an equity market that is being fueled by and large by the federal government. U.S. share of equity capitalization relative to GDP has risen steadily in the U.S., although not so the rest of the world. This is a great, great chart because when we do get that yield curve inversion and the sell-off in the equity markets in the United States, I'm not going to be running in to buy U.S. equities unless they're dirt cheap, as measured by the Buffett indicator, which they're nowhere near, evidently. However, if we sell off, the rest of the globe sells off. Therefore, these cheap stocks are going to get cheaper. And I want to be a buyer of emerging markets. We already own some, but I want more. And I want a lot more because whatever the fix is for this crisis that we're having in the United States, it's probably not going to be good for the equity markets for quite a while. So I want to be outside the United States. Larry, welcome. We didn't expect earnings to be this good. Why wouldn't stocks just keep going up? Jerome Powell is just a babble at this point. So I think we need to put into context earnings, right? So what have they been doing? They've been revising down expectations and then beating. So really, are we really beating by a mile? Okay, if we're gonna say, okay, our benchmarks are going to be that we are going to benchmark the market by how they beat expectations, then yeah, I would agree with you. But I don't think that we have that I don't think that we have true earnings growth as we traditionally would like it on a year over year, on a quarter over quarter basis in many, many stocks, most stocks, with the exception of those few, really, really few stocks, the NVIDIAs of the world, SMCIs of the world, whatnot. Now, your point is a valid point. We know from history that PE multiples really don't matter. They only matter until they matter. When the equity markets, the only time PEs come up in conversation on CNBC is when the equity markets are rolling over and they're looking into, they're going, oh yeah, well they were overvalued. Well, nobody talked about it on your network until the equity markets went into free fall. So PEs don't matter. They just don't matter. I think that they can only matter if you have an apples to apples comparison of a stock in, let's say, in the staples sector. You have an average for the consumer staples, and you have one stock that is highly above the average, yet their fundamentals are on par with the rest of the bunch. There's nothing outstanding. Then that matters. Then you're going to have a reversion to the mean. But by and large, it doesn't matter. They don't matter. And I remember some guy, where I got that line from was back in the late 1990s, and this guy got killed. He came on CNBC, and he goes, PEs don't matter. And it was a different world back then. It had more sanity back then. And the guy was destroyed. And then ultimately, going back to where PEs went up to back then, we had it on, this is the S&P 500, nearly 43 multiple on a trailing PE basis. That was insanity. So equities can still go up higher. Twitter, you're killing me. All right. So let's take a look at copper. And it's not just a copper story. This is a commodities story. New all-time record highs for copper. Now, why is this happening? What's happening is that apparently when they put the sanctions on Russia for the invasion of the Ukraine, they didn't ban some exports of industrial metals. In this case here, you had a ban that was invoked in, I believe, April. In their conclusion, we wrote that history has taught us that the market will price in some full sanction risk premium, which when combined with the current macro bid, reflective narrative, electrification, copper is the first AI commodity. So what do they mean by that? So they're banning Russian metals, export of metals into the West. You have energy demand that's set to double within the next 5 to 10 years. Why? AI. And what they're also doing now, copper is becoming so expensive, the Tesla charging stations are being vandalized for what? Their copper. Copper is in huge demand right now, and it's only going to increase in demand. This is why we've been focusing so much on the futures market in terms of commodities of late. So copper prices moving up higher. Now, I mentioned it earlier, and this is all inflationary. Whenever I talk about an individual commodity, maybe saying, Jesus, what does this matter to the stock market? It matters because we have a trend, we have a theme, if you will. We have commodities which are ripping through the ceiling. Rough rice right now. I am long of rough rice because of a squeeze that's taking place in the rough rice arena. I think it's symbol ZL. No, that's soybeans. ZS? No. What is rough rice? This is going to be a great little trade. This is why I'm wasting a little bit of time doing this, but it's worth it. Here, rough rice, ZR. ZR is the symbol. Now, when you take a look, forgive all these lines, but I put them up here for a reason. I want to know my support levels. I want to know my resistance levels at which to sell. So this orange band here, those are your Bollinger Bands, 2 standard deviation Bollinger Bands. In tan, whatever you want to call this color, are your Keltner channels. This is a major, major setup for a Bollinger Band squeeze, and we are grinding up higher. This could get resolved in either direction, up or down. You don't really know, but right now we have a moving averages stacked positive. Therefore, in all probability, we're going to get a resolution to the upside. And the trend, by and large, is up. Look at this wedge formation on a weekly chart. And I know, rough rice. Why am I listening to a guy talking about rough rice? Because it's money. You can make a lot of money in this stuff. So back to that daily chart. So we have the potential for a major, major breakout here on rough rice. And I plan on adding more very soon, if not tonight. Jody, welcome. Welcome. All right, so that's rough rice. Let's talk about the yield curve. So I kind of teased this at the very beginning that we had a very strong April, very, very strong April for the yield curve. It broke out. Let me take Talon's question. The man, the mission. Bob, if they run the market up in anticipation of a Fed rate cut, what happens when they start hearing that a cut is going to happen? They'll probably go parabolic. They'll probably go parabolic unless, of course, the economic data begins to really drop like a hot rock. And the economic data that I would focus on most are initial jobless claims. Falcon, it doesn't matter if it's rough rice or sand, it's all money. It's so true. I love that saying. It's so true. So, yeah, they can make this market go parabolic. And again, I'm going to be the last one to tell you, oh, the multiple, you got to be careful. I'll say be careful. We're on thin ice, but, is that a reason to dump my stock? No, definitely not. All right, so back to the yield curve for a bit. So here's a chart for April. This is a monthly chart, and we broke out last month. And right now, this looks pretty darn bearish, therefore bullish for equities. That's one way of looking at it. But one thing that I've spent a lot of time on this evening, and I did it for a reason, is to drive home the importance of a retest. Are we seeing a retest of prior support? Here and in dashed blue line. Here, what was resistance, will it now act as support? There's no reason to believe that this is going to collapse. There's no reason to believe it whatsoever. I think that there's a very, very good chance that this is a retest of last week's breakout point. And a big mistake that those who do use monthly charts make, or weekly charts, is that they'll look at a chart like this on a Thursday or on a Wednesday or on a weekly chart. They'll make a determination of how the week is, or how it's going to close out. They'll place their bets based upon that. Right now, to me, it's the 16th of the month. I have a bunch of trading days left to go. Look at all the damage that's been done to the yield curve in the first half of the month. We still got another half to go. So I wouldn't be the least bit surprised to see a bounce back in the yield curve. That's what I'm watching out for. Right now, is this updated for today? Yes, it is. No such luck. Let's take a look at a weekly chart. Clear rejection at resistance, right? So one trading day left to go in the week, right? A lot can happen. What's coming out tomorrow in terms of economic data? Leading economic indicators, that's important, but I don't know how important, to be honest with you. I don't think it's going to be major. So a couple of things occur when the yield curve uninverts, when it steepens. And for those not familiar, the yield curve, the one I use is 2-year Treasury yields versus 10-year Treasury yields. Basically, you have the 2-year Treasury yield that is paying more in interest. That bond is paying more in interest than a 10-year. That's ridiculous, but that's reality. But when that uninverts, that means that the bond market is normalizing and the equity markets go into free fall. So one of the primary things that happens when the yield curve uninverts is that oil begins to rally. Now, I would argue that the rally in oil has already begun and that we got parabolic, overbought, and we've dropped back down into this trading range. So the one thing that we're going to be looking for on this chart of the yield curve, and again, I apologize for all the squiggly lines, but they matter. In black, I have oil. And take note of every single time that the yield curve steepens, it is a oil supply shock that just happens to coincide with the steepening of the yield curve. So here, 2000, what was happening? Oil rising up sharply. Back here, 2008, oil rising up sharply. Here, this is, I think, long-term capital management around here, taper tantrum. Not that big of a move. Then, of course, in 2020, oil shot up higher. The thing is that we have remained high. Every single time that we've seen a inversion of the yield curve, oil has generally dropped down below where the yield curve is. Now we're elevated beyond it. We've already broken out and above it on a relative strength basis, meaning you already have gold and oil already leading the charge up higher because gold also has led the charge higher after the steepening of the yield curve. These are already rallying. This is already happening. And then you take a look at the utility market. The utility market right now is screaming. The Fed is cutting rates, screaming it from the rafters. Why would that be? Why does the utility market forecast interest rates? Utilities compete for yield. They are big issuers of debt for maintenance on their facilities, for expansion of their facilities, etc. So they compete with treasuries. Now, if treasury yields go down, they're believed to be a safe haven asset, whereas utilities aren't. They're safe, but not as safe as treasuries. So as the yields drop, or the anticipation of yields drop, well, you have utilities that rally because their fundamentals get better because their borrowing costs just went down. That drops straight to their bottom line. Also, investors know that if yields go down, what they're going to be earning on their treasuries goes down as well. What do they want to buy? What does well in a rising interest rate environment? Utilities. They pay a dividend, and you have the capital appreciation on top of it. So right now, the utilities sector is saying the Fed is going to go. They're going to go. They're going to cut rates. Major breakout monthly chart here. Now, what if you factor in another area? This is another view of the yield curve. I've added one more line to make it even more squigglier, and that is the consumer staples sector. Another safe haven play and a play that pays a yield. So overlaid here in brown, as the yield curve steepens, what went up in 2000? Staples. It uninverted here, 2007. What did consumer staples do? They rallied. And even back here, they rallied. They had a huge rally here. So all of these confluence of sectors are all combining now. Gold, oil, utilities. They're all on this chart. You see what happens when you get an uninversion of the yield curve. They all rally. They're all rallying already. In the past, it took the steepening of the yield curve to get them all going in tandem. That's not the case right now. It's not the case. They're already ripping up higher. This is a composite for inflation. Gold higher. Utilities higher. Oil higher. Staples higher. They don't go higher because they don't have pricing power. They go higher because they do have pricing power. There's inflation. And that is going to be the pin that bursts this bubble. Let's take a look at the weekly charts. I want to talk in particular about the Qs and support levels. First, the yields. This is the 800-pound gorilla in the room. The 10-year yield last week, it closed up, bullish reversal bar by Friday, end of business. This week, we're down by 2.82%, but we are holding support. Could this be a double top? Sure. I don't know. Could it be a pullback setting up for a breakout to higher high? I don't know. I guess so. We only trade of what we can validate. If we break out above 47.37%, we will be short the market. If we break down below this key support level and close there by end of business on Friday, equities are going up. Simple as that. Unless, of course, they drop like a rock. Then something has happened. Then the Federal Reserve is doing an emergency rate cut. Equities are in free fall. We're not there yet. So that's where we stand. I'm looking for that short-term pullback in equities, retest of a support level, then they're going up higher, assuming that yields don't break out. What is Bitcoin telling us? It trades as a risk asset. Guess what? Bitcoin is at current weekly chart trying to break out. Let's go to a daily chart. Down at current. I've been saying, I think that, and I've said this since 25,000, I think that we're going to 80,000 on Bitcoin. I have zero fundamentals about Bitcoin or halvings. I have no clue about what that is. But the chart is telling us, the monthly chart is telling us that we're going up higher. So what we did here, we broke out. This is real time. So this is really tomorrow, this pullback here. And this is today. We broke out and we are now, we have retested that breakout point. Looks as though we're going to get a follow through. This is what we should be seeing in the equity markets, but we don't have it yet. Bonds up at resistance, Treasury inflation protected securities, weekly chart breaking out. The tip market is saying, hey, listen, we believe that there's inflation. We don't care what the Federal Reserve says. We don't care what the CPI, PCE, PPI, whatever three-letter report you want to put out there about inflation. We don't believe it. And I think the government's going to make it worse. Therefore, I want to buy tips. They're going up. Dollar retested the lower band of its rising up trend channel. Is this a break for the dollar in terms of it's done going up, or is this an orderly pullback? Volume is saying it's an orderly pullback. The however is that the euro is breaking out. This is a weekly chart, not insignificant. I need to rephrase. It is not breaking out. It is at resistance. So my apologies. Now here's the fly in the ointment for the dollar. Japanese yen. If you get a breakout on the euro joined in by the yen, dollar's done. Dollar's going down. And it looks as though we're putting in a higher low. We're getting ready to break out on the Japanese yen. Inflation over there is just way too high. They need to do something. They need to strengthen the yen. Volatility on the week, horrible. But taking a look at a daily chart, we're at support. I mentioned last week that that we were probably going to break out. We did. Is this going to be a retest of the breakout point, just like the yield curve? Jury's out. But there is no fear in this market. Puts are at historically cheap prices. The Dow transports down on the week. No confirmation of the new all-time highs. What the hell? You got to be kidding me. No confirmation of the new all-time highs by the Dow transports. That's not a good thing. The Dow theory is that one is complementing the other with a breakout or a breakdown. They're not. There's a divergence there. S&P 500, new all-time record highs. There's a problem. This never happens. What do I have? Too many windows open? Yeah, that's what it was. Edge. Here's the problem. We broke out to new all-time record highs. And there's no volume. This is not institutional accumulation. This is short squeeze stuff, algorithmic trading, all light volume stuff. And I'll tell you, I've seen this before. And if you do not get volume to the upside, or let me put it this way, if you have a breakout to new all-time highs, no overhead supply above, clear blue skies, and you don't have institutional money following that, what does that tell you about the health of the overall equity market? It's saying the big guys are like, hey, I'm going to sit this one out. Even Stan Druckenmiller dumped, I believe, all of his NVIDIA position. Now, on a daily time frame, the S&Ps, bearish, key reversal on the day. Not horrific, but let's get our crayon out here. What hasn't happened? There was no check back for this breakout. There was no check back for this one. No retest. It's just been a straight shot higher. So that makes me want to do this. That's a very, very narrow ascending wedge formation. This is why I think the equity markets need to pull back, retest a couple of support levels, consolidate, then move up higher. And that could be what the big money's waiting for. Will this breakout last? That's the big question that they may be asking themselves. Now, the Qs, let's do weekly chart first. Great, good stuff, right? Great breakout, new all-time highs, rah, rah, rah. Very exciting. There's the breakout point, weekly chart. One trading day left to go. We do not know if we have a real breakout yet. Because I'll tell you, I've seen weak volume. I don't even know why I have that there. I've seen weak volume, but this takes the cake. This is pathetic. Now, let's go to gold and see how that's looking. God damn, I'm sorry, folks. I had way too many windows open. Monthly chart gold. Wow. Monster. Monster. Beautiful chart. Wants to go up. Path of least resistance is higher. Thin volume so far, but it's early in the month. Weekly view. Continuation move up higher. Volume should come in about average. Daily view. Down session. Retest of 23.75. I think we go up. Let's do some chart requests. Folks, we're going to be using TrendSpider. There is a 35% discount code below if you would like to join up. Awesome automated technical analysis. Insane scanner. If you want to know how I find these Bollinger Band squeezes, I have this special squeeze here. And what I'll do is I'll take we could use a daily time frame, S&P 500, and bam. I know every squeeze that's setting up either negative or bullish or bearish, doesn't matter. Look at these tight Bollingers in black inside the Keltner channels. WW Granger, this is probably breaking out. Lamb Research already begun to break out. That's a little bit, oh, Super Micro I missed. Deckers at resistance though. All these names. Martin Marietta failed. That could be earnings though. Adobe, they're reporting earnings soon. Look at the setup here. Higher low. Looks like they're getting ready for a breakout. Microsoft, Bollinger Band squeeze already fired off. A little bit too late for that trade. You can see all the opportunities that you have here. So great product, great tool. I have the code for this this scan. So if you join up, you need it, let me know. Okay, let's do some requests. We have ASPN. Okay, ASPN. Aspen Angels. Never heard of it. Monthly chart first. Beautiful, beautiful breakout here. Remember this number, 2250, 2250. Extended. I would not initiate a new trade here. Daily chart. This could be setting up for a breakout. Now, I said remember 2250. And the reason is that you have a great breakout here. But again, I'm very, very OCD. I need to see retest. I would only be a buyer of this stock if we pulled back next month and did a retest of 2250. I want to know that what was resistance is now support. So that's the number to watch. I'd be a buyer. Not now. It's too extended. I wait for that pullback. 2250. That's my number. Calmaine. Calmaine Foods, great little egg company. I owned it once upon a time. Very, very volatile, thinly traded. Momentum looks really, really good. You have a good consolidation here. We broke out in December, retest January. Not much headway since then. Bearish reversal bar last month. I think you need it's a volatile stock. Let's go to the weekly chart. I'm torn here. If we close above resistance this week and above this volume shelf at, let's call it $58 a share, and we do a retest next week, I'm a buyer on that retest, stop loss right below it, and then I'd be out if we get stopped out. Daily chart. We broke out on Tuesday, Wednesday. Technically, we failed to hold, but today they pulled it back off of the VWAP. I'm okay with nibbling here and then adding more next week on that retest. I would leg in. This is a very volatile stock. Leg in. It may look docile. Right now it is. But, man, when this thing goes, it really, really goes. Sean, I know you know that because you've been around and we've traded it together. VITL, Vital Farms. Another really good-looking daily chart anyway. I don't know what the monthly chart looks like. Whoa! Whoa! Mamalution. I can't condone a buy here because it's so extended. Daily view. Yeah, you got a lot of overhead supply here. I'm not a buyer. It could have better fundamentals than Cal-Maine Foods. I don't know this company, so I'm not going to knock it. I'm just going to speak on a technical basis. It's extended, very, very extended, and it's consolidating and stuck at some resistance levels. So I'd be careful here. I think that the safer bet, it may not be ultimately the outperformer, but the safer bet from a risk-reward perspective right now is Cal-Maine Foods. This one here, a little bit too frothy for my taste. You're welcome, Sean. Anytime, pal. And folks, thanks for being here. Always a pleasure to spend my Thursday nights with you. Don't forget, like, subscribe. Don't forget TrendSpider, link below. And I will talk to you soon. Have a profitable trading day tomorrow and an awesome weekend. See you Sunday night. Be well.